Hi, welcome back to Family Investment on the 17th of May on a Monday. The market, especially the tech sector, seems to be still on a sell-off. Are we at the bottom yet? Because it's been quite a while. So in this episode, which is in fact the second one after the demand from you viewers, that I'm going to cover 10 key stocks, 10 popular stocks on the technical Fibonacci chart to see the floors, support floors, and the ceilings on where we are, to see whether if it's going to be a bounce up or a further fall, destructive fall. So before I go further, please appreciate an early thumbs up, like, and also if you're impatient, you want to know any of the stocks, go to the description below. It should be a timed link and you can swap and jump whichever suits your needs. So the first one, I want to begin with Amazon. I think this is important. Why? Because Amazon, Apple, Facebook are all these key mega cap stocks that's holding Nasdaq up. For Nasdaq to fall even further to deeper correction territory, I would say 8% or more, Nasdaq, Apple have to hold up. So with Amazon, with one of the key Nasdaq stocks that are holding up at $3,180 per share. So it's holding up really, really well. It's not falling, great earnings, but it's going sideways for quite a substantial period. So it's in the earning zone and also falling to the swing zone. Swing zone meaning it goes low and then goes to earnings zone up and down. So just swing around that sector. But if Amazon starts cracking below 2,960 and it drops towards the 2,700 area, so that's a good 5, 6, 7% that could crack Nasdaq. That could crack the likes of Apple and Microsoft as well. If the sell-off on the big mega cap FANG stocks go even deeper, then we will see a deeper correction. So where we stand with the tech sector, is it going to be bounced or not? It depends on how these key FANG stocks are holding. But luckily the Q1 earnings has been really sustainably great, so they just have to go sideways for as long as we can. Just have to hold the foundation, hold the floor. So this is where we are. That's why I'm bringing this up. Again, it's going sideways for quite a while and breaking out to above the 3,600 sector, going to the 4,000, the actualized value. We have to see, perhaps not this year, perhaps going on to the next year. So we have to be patient with the Amazon stock. If you own a bit Amazon, it's good. It's quite defensive at times like this in terms of the technical tech area. So the next one, another mega cap stock, is NVDA. Okay, NVDA, similar to Amazon, is going sideways, but in fact it's going not just 6 months, it's going sideways for at least 9 months. Great earnings, breaking record, exceeding expectation, and yet they're going sideways. Remember, their future value has been covered in, the future value has been captured. Going sideways is just waiting for the earnings. They're giving chance. Wall Street is giving them chance, letting them the earnings actualize the value and move on. Okay, so as you can see, as we stand just now, it's around about the 560 zone mark. Okay, so 560, a very strong support line, and there was an attempt to break it below, going towards a $520 mark, but it failed attempt a few times. It always bounced up. It's always bounced up. Folks are always buying on the dip and moving back up. So it's a very strong. But then if you're one of those long-term investors like me, waiting for it to break up towards 650 range, going to 700, 800, I think we have to wait. But as a business fundamental, this company is just great. It's just great. It's just expanding as it goes along. It's following its roadmap, and you're just waiting on the ARM buyout. If the ARM buyout is successful, it's just going to shoot NVIDIA above $1,000 stock. But we have to be patient. We might not see in 18 months, not 2 years, not 3 years, but 2025 is my target that I want to see. So long-term investing, if you are NVIDIA or if you want to get into NVIDIA, this is the time. So use my zone between 519 to 556. That's your buy trigger. Within that zone, if you go above, you're overpaying a bit more expensive. So the lower, the better, but that's a good safety marginal zone to go. And that's where we are just now. And again, it's going on a very strong support. If it dips below that 520 area, then it tells that it's not the company, it's actually Nasdaq and other tech companies correcting even deeper. Okay. Next one, the popular ARK Invest ETF. ARK Invest has not been on its good days. Okay, it's dropped to at least 30-40% just now. It's sitting on a breaking support of 102 and it's already cracking the 102 support. It's cracking its seams, and the last support, as you can see, is 85. When I say last support, it's because when you bring Fibonacci retracement method up to 100%, that's when you lose half the value of the stock from its all-time high. So if you go to the last support, I don't know how long it was going to hold. You know, when ETFs are different, when people redeem for the ETF, when they take the money out, it causes a bottleneck. When it causes a bottleneck, there's a huge sell-off in all individual stocks over a period of time, and then you will see a huge decline over weeks or even months. So we have to be careful with this ETF, and now it's just breaking support. People are taking money, rotating away to more safe haven value rotation or opening trade stocks. This is what's happening. But for you long-term investors, for you younger investors, ARKK is still a good stock, but you have to understand the breaking support. Who knows? We're sitting at 102. If it's strong enough, it will rebound if the tax recover. But if it's not strong enough, if things starts cracking again on the tax stock, then you see it go even lower. So you just have to be aware on your risk and reward. And also, again, be unemotional about it. Make a rational decision. Okay, next one, very popular NIO stocks. Okay, NIO, one of the most popular, some call it the Tesla of China, but people do argue the fact that Tesla has got gigafactories, but NIO is only hiring out a lot, trying to produce 10, 20,000 cars every single quarter. Again, they're growing at a very rapid rate. We have to give them time, we have to give them a chance. But remember, they were $62 at some point in time a couple of months ago, and now they're breaking through the cracks. Business, in fact, is expanding, cars is improving, they're expanding to Norway, battery swapping is acceptable in China. So business is still going as per roadmap. Perhaps we have been overpaying the future values, but as we stand just now, it is at a very strong support of $36. Okay, $36 support. Strong support of $36 has been cracked. Now is going towards the next support level of $30 per share. So if we break that support level, if the support isn't great enough, if we don't see a rebound up on this Chinese EV sector, we will go lower to 20. But it looks like they're trying to develop. I think you can see the stock itself is trying to build a gap. They're trying to build a strong foundation on the $30, between $30, $36 per share. So you have to give it time. Don't expect to happen in 2 months, 3 months, 4 months. Give 2021 the year for NIO to actually spread its wings and flap and get used to it before they actually fly. So give it time for NIO. But if you're new investors, you have your risk and reward chart here. You can see where you are and how low you go. So the risk is getting lower as it goes lower, obviously, and the reward is potential for long term. Next, Tattoo Chef. Tattoo Chef is one of the SPAC stocks that people speak about. I tend to ignore it because I don't really favor, because I believe in revenue and growth. Okay, but the SPAC stock, to me, it looks like a pump and dump. I'm sorry to say, but it looks like a pump and dump. It's going declining. It's breaking its floor. Last floor ceiling of $17 per share. Now it's going to go even lower to 14. Okay, so it's trying to rebound up to break the ceiling. The revenues and sales growth are not looking great. So this, despite the EPS, there's no revenue. This company is still growing. It's still trying to find its feet. It's trying to expand. It's trying to figure out the money, what they're going to do, how they can expand factories. So to me, it looks like it's on a decline. It's going to take quite a while. Give it time for it to actually earn some EPS, to earn some revenue, and from revenue they're going to start breaking even. It will take years. Okay, it will take 2, 3, 4, 5 years. Okay, so you need to give it time. If you're owning the stock, you have to think, are you going to wait during duration? Fine. If you are, then buy on the dip. Try to hold this as your top 3, top 5 stocks. But you have to be really, really patient with them. You have to watch their business, and you have to have an exit strategy if the business doesn't follow through. Remember, there's only sufficient money. There's only amount of investors that are patient enough to wait. But for me, I would leave Tattoo Chef for now, but I will let you make the decision. With no emotion, just look at the chart, and the chart will tell you 1,000 words. Next one, Nano Dimension. Okay, Nano Dimension, I admit, is one of the stocks that I believe that is going to go 10x. But then with the sector, with the inflation data, and the company knowing that it's not going to be making revenue, the CEO says that do not expect any EPS or great revenues coming, but they have zero debt. Okay, they're looking to buy out companies. They're looking to issue more shares. They're looking for expanding. Okay, but as it stands just now, it is at a support line of about $7 per share. And then if it breaks, it's already broken the $7 per share. Is it going to rebound? In fact, if it does want to rebound, it needs to go to $4.59 before it rebounds, before it touches the floor and goes up, or it could bounce from there. But again, so it looks like it's going more on a downward spiral trend rather than upward. So if you want to see it rebound, how high would it rebound, Alex? I mean, if it does rebound, it's going to go to $7, between the $7 and $8 sector. It's going to sit there. It's going to hover for a period of time. That's what my take is. It's going to hover a period of time until it starts expanding. Great innovative product, great business, great CEO. Again, you have to give it time. Okay, we are coming to a point where growth stocks with high inflation rate is not going to be a flavor of the month. So you have to give it time before it says anything. And the CEO did say you don't expect great revenue for at least 4, 5, 6 quarters. Next one we want to go is ABNB. Okay, we like ABNB. It's a great opening trade, and in fact you need to know that ABNB has passed its 6 months expiry date, and now existing shareholders or long-term shareholders can redeem the money and become actual billionaires. So this is one of the reasons why they are falling. Is breaking to the last support line of 140, is going lower and lower, but again, it's all risk and reward. Is ABNB worth the $80 billion price tag? You have to ask that yourself. With the opening trade, we have to see. With the last earnings, quarter Q1 earnings, it's not unfair to them because they're literally not open up yet. So you need to give at least 2 terms, 3 terms before you actually see if they can actually prove themselves worth $80 billion. Is this an opportunity to buy or opportunity to bust? You have to decide. You do your case study. This is just an unemotional chart because of the sell-off of the rapid decline due to the 6-month redemption, and people will just want to be billionaire because, you know, some of the investors in ABNB has been there since day one for the last 12 years, and you know, it's no crime selling off now, but if they sell off, it might be your chance to buy in. Alright, before I go to the last few stocks, I just want to give a shout out to my sponsor eToro. I am a champion investor in eToro, and I also have an affiliate link with eToro. eToro is great. You can buy Dogecoin, you can buy Bitcoin, you can buy stocks, you can trade, you can swing. But I use the forum for swing trading, and also I'm a popular champion investor on the platform where you can copy me. So do check out the eToro platform. It's good. I like to use it, and you know, no doubts about it, I use it on an every single day basis, and I'm very transparent about my portfolio. So do check out eToro. Okay, I've got 3 more to go, and the third last one is JMIA, the Amazon of Africa. Okay, the Amazon of Africa, this is chart here, and you can see poor earnings, no revenue growth, weak business expansion. They are one of the biggest continent expansion in the world, but they are not growing. Steady decline in stocks, they're getting shorted, they're moving to 22. And how long are they going to go? If you want a company to rebound and grow, you have to grow geographically. Okay, you have to do good revenue, good sales, good expansion. They're not demonstrating that in the last few quarters. They're just all over the place. I'm not sure what is going on in there, but to me, I've avoided JMIA since as low when it was at 10-20 bucks. I've never invested, I've seen it gone up, but I'm still not investing because again, there's no business fundamental behind it. It's gone through its pump and dump until we see significant changes. It is still a very high multiple stocks and no revenue sale. So be careful what you own, and this is where you are. Support line at $22 per share now. And if it goes lower, then the last support zone is $8, so it's quite a deep fall. But then it could bounce back up to $30 per share. Could it bounce higher? I'm not too sure myself. Okay, so that's the zone if you could bounce 22 to 30, but if not, it's going to drop below until as low as $8 per share. Okay, next one is Alibaba. Alibaba earnings came out, you know, they show some decline. They missed the EPS because of the fine they had. Okay, but still, they're still breaking barriers down. They're still opening shops. You know, they're doing what Amazon is doing in the West. Okay, Alibaba is doing just the same with the expansion of the cloud. And you can see that they're already breaking floors down and down. They're going up like and down like a pyramid. Now it's pushing towards the 212 again. Could it go lower? Could it be filling gaps between 181 to 212? I think that's a good zone to look at to potentially buy in. If you want Alibaba to grow, you just need to give it time. I mean, the value investors are actually looking at this as one of the best value tech stocks out there. One of the best value tech mega cap stocks out of America, and Alibaba seems to tick all the boxes. Okay, tick to the boxes where Charlie Munger even think that it's worthwhile to buy, and he got it in one of his top 5 stocks. So this is where Alibaba holds, and if you think it's a value stock, give it time. Again, but this is, we are at a low. Every time it goes to below support floor, it breaks the support floor, new investors would have a lower risk going in. So if you're averaging down, you have to think about averaging down, because the more you buy, the more you spend. But how low can we go? We have to watch and see, and again, give it time. And the last one is Shopify, one of the stocks that made a lot of people rich in the last 5 years. One of the highest growing stocks, one of the most popular stocks. And it came to a point up to 2019, it went up to as high as $1,000 per share stock, and it's gone stagnant, it's gone sideways. Regardless of the great earnings that it's bidding, it's expanding, it's showcasing that Amazon are not the bully case no more, and it's still good. But then if you do valuation, I've done valuation on Shopify. Shopify is still literally a $400-500 stock. We're actually paying double. Even though paying at 100, you think it's a good support floor at 104, we're still overpaying for Shopify. Okay, for me, I have the Shopify zone 1 and zone 2. If I were to be swing trading, Shopify would be something I would swing trade. 903, swing up all the way to 114. That's the zone I like, the zone 1 and zone 2. So if swing trader, great. But if you're buying for long term, averaging down, make sure you buy it on the lower end between the 93 to 104, or even lower if it goes down because it's gaps yet to be filled. And also we have to bear in mind with the growing inflation interest rate data, we potentially could see Shopify drop to as low as $800 per share. Because again, look at the chart, there's no gap fill. It just went up in a straight line and it hovered on the top. But potentially it could come down until we see 2, 3, 4, 5, 6 great quarter earnings for at least the next 1-2 years before it breaks through the highs of $1,500 per share. But I don't think there'll be any breakthrough for 2021. That's my humble opinion, but I thought I want to share with you. Don't buy this stock thinking it's going to go 1,005, because remember, growth stocks are not great during this recovery of rising interest rates. You have to face the music, you have to face the facts. But if you're long-term investors, Shopify is one of the top 3 stocks. Great choice. Long-term horizon is amazing, but for short-term now, it's going to get hurt, and this is where the support lines are. Oh well, time flies when you're having fun. Those were my top 10 stocks. Again, go back on the link below if you want to go back to any one just to revise and take a screenshot on the Fibonacci retracement method. I hope this is useful. But if you really do find this useful and you want to see more videos like this in future, leave a comment below on the stocks that you would like me to cover. Perhaps this might become a series in future until we see the actual bottom. And again, invest safely, no emotion, focus on the support levels and the next ceiling, because it could go down the way or it could rebound up the way. And this is where you buy your entries or exit your entries. Take care, thank you, like and subscribe, and hope to see you soon.
I hope you enjoyed that video. If you want to see future videos, please subscribe to the channel and press the bell button. Bingo! More videos. Bye!